Hi, I'd like to talk to you now about how to record foreign currency transactions, and to demonstrate this I'm going to use an import transaction. The critical thing here is that it is generating a foreign currency payable, and we'll see how that is treated from an accounting perspective in terms of AASB 121. The example I have here is Poor Trading, which enters into an agreement to purchase air conditioning units with a value of $100,000 from a US manufacturer. It makes the order on the 1st of March, and the air conditioners are shipped and title passes on the 31st of March. The exchange rates on these respective dates are 75 cents and 72 cents. Now, the critical point to think about here is, when would you recognise the purchase transaction? It's not at the date of order, it's on the date when the title passes and when the inventory, that's what it is for Poor Trading, has to be recognised. And so on the 31st of March, you'd recognise inventory being purchased and you'd recognise a foreign currency payable. The payable is $100,000 converted to the exchange rate on that date, because it's a monetary item, and it'd be $138,889. So we recognise a payable on that date and an inventory amount being purchased. Now, the transaction is not settled until the 31st of July, and this is after the end of the financial year. The exchange rates at the 30th of June are at 70 cents, and on the 31st of July, when the transaction is settled, it's 67 cents. So, because it's a monetary item, and because it's a foreign currency payable, it has to be adjusted to its current value at year end. So at year end, we'd have to adjust the foreign currency payable up to $142,000, which is $100,000 at 70 cents. So we're going to increase the foreign currency payable to $142,857. So we need to increase the payable by $3,968. And the increase in the liability represents a loss which needs to be recognised in the profit and loss account. On the 31st of July, we settle our obligation and we make a payment. When we pay the foreign currency payable, the amount that we pay is the equivalent of $149,254. And so we recognise the payment settlement of the foreign currency payable, $149,000. Cash and FX payable, and we have to recognise the difference between the current balance and what we pay, $6,397, as a loss, which again goes into the profit and loss of the income statement. So what we can see clearly demonstrated is here is that between when the date the inventory was ordered, when we thought we were going to pay $133,333, until the date that we paid for the inventory, the 31st of July, we ended up paying $149,000, and so we effectively ended up paying $16,000 more than we thought we were going to pay. And we recognise that loss progressively over the period until settlement is made. Thank you.